podcast is intended and contains general information on financial strategies, investments, and products only. Whilst Luke and I are both licensed financial advisors, we don't know your personal circumstances, goals, or objectives. We highly recommend that you reach out to your financial advisor or investment professional to discuss any of the topics that we've covered today before taking any action. Our full disclosure, copies of our financial services guide, and additional information about Seneca Financial Solutions and Bold Wealth can be found in the show notes.
Hello and welcome to a special summer edition of Wealth and Toil. 5 to 10 minutes on 4 topics for 4 weeks while Dylan and I are off sunning ourselves on the beach somewhere. Well, Dill's probably getting rained on in Hobart, but I'm over in the West having a beer with my family. And so we're going to cover off 4 interesting topics for you guys. Today, we're talking about emerging markets. I think it's been one of the more frequently asked questions I've had since doing Equity Mates. I think the boys are telling everyone out there that they need to use an active manager for emerging markets. Why should you invest in emerging markets rather than just investing in the US, S&P 500 or equivalent?
Well, it's an opportunity for alpha, right? Like, emerging markets are a possibility for you to get an exposure to somewhere that could be an incredibly high growth opportunity. It could be somewhere that has really high royalty markets. It's another exposure that's not the US, Australia, the UK, that diversifies your portfolio and gives you an alternative source of performance.
I'll tell you what I like about emerging markets. There's two things I really like about it. Number one, emerging markets are higher growth. Developed markets, by definition, are lower growth. So from a geographical perspective, the emerging middle class in China or in East Asia, an increasingly educated and expanding population base in India, some of the dynamics in parts of Africa and South America, these are all Mexico and how that's booming at the moment. Well, you're not going to get exposure to businesses that are exposed to those geographies necessarily on the S&P 500 or on the ASX 200. So that's really important. Number 2 is these developing emerging markets don't necessarily have the same regulation, disclosure, accounting standards that go across markets that are more developed and, generally the more Western markets, traditional investment markets. As a result, there's heaps more crooks, there's heaps more people doing the wrong thing, but there's also lots of people doing the right thing. But if you're buying an index fund, they get all lumped in together. If you're buying an active manager, they're able to use their knowledge of those local markets, they're able to use those knowledge of those local companies and people who operate there, and they're able to find those accounting anomalies and hopefully avoid some of those more crooked, corrupt elements, and they're able to invest in those better elements, those businesses that are growing, those businesses that do have the most exposure to that GDP growth that we're chasing, and some of those structural tailwinds in those markets. So I think that is the key argument for investing in emerging markets, and the crux of it. How do you find a good emerging markets manager? Well, the reality is you don't have the data to make the decision. So what you should do is come and chat to Dylan and I, and we'll help you, figure out a way to get some good exposure, and you can go from there.
I do think that the exposure to a high growth country is often overlooked. If we look at, say, 30 years ago where China was, and look at the exceptional amount of growth that's happened in that market from a financial standpoint, incredible, right? I don't have the stats necessarily in front of me, but I would say that China's been the fastest growing economy in the world for the last 25 years. Maybe recently been overtaken by India, given the population growth, and China's, entered that middle class. But if I'm an investor, I want exposure to that sort of long-term outlook of growth. Absolutely. The challenge, like you say, is in picking the stocks. And I think indexes for emerging markets are inherently flawed, because you're just going to get exposure to an entire an entire market where... Can I give you...
Sorry to interrupt, just while you mentioned that, actually, I just come up with one other good thing, and it makes why you said indexes. So often in emerging economies, you have 1 to 2 or 3 companies that dominate the index of listed companies.
So like Australia with the banks.
Similar, but even more so. So I think a market cap weighted index isn't going to give you necessarily the best exposure to broader economic growth as it would, say, maybe in America or in Europe or in Australia even. I'd argue not, but you get my gist.
Yeah, no, 100%. I think that the picking and choosing of companies within that market, and someone, ideally having someone who's there and on the ground, who have a team there and on the ground in that particular country or region, is a really good starting point as well. So,
Dill, how much allocation? How much allocation to emerging markets of your equities?
We generally won't have more than 10%.
Oh, too low.
No, I mean, like that's overall equity. So if we're talking, we've got an Australia exposure and a global exposure. So within the total exposure, it wouldn't be more than 10%, but within global, it's probably closer to 20.
Okay.
Yeah.
So for us, we would say if you're depends on what else is in your portfolio. So if you've got a really diversified portfolio that has some, if you're investing in an MSCI all world type product, whether that's an index or an active product, but a product that invests all over the world, you're going to have some emerging markets exposure already. So you might have less. If you are more of a sort of developed emerging split, and the managers you choose just focus on developed or just focus on US or just focus on Europe, well, you could probably dial the emerging markets exposure up. Difficult to say. I'd say at the moment we have about, in global equity SMA, we have 25% sort of direct emerging markets exposure, and then maybe another 5-ish, less than 5-ish, sort of indirect. Without
some of that'd be Japan though as well, which probably
I don't count Japan as an emerging market.
Yeah.
We don't count Japan as an emerging market. So Japan's developed market for us.
That's what I was going to say.
So we're Asia, like I'd be thinking about it as Asia ex Japan, but I prefer to think about it as like the a proper emerging market, so you can include everywhere else as well. South America, Africa, the Middle East.
For everyone,
anyway.
And I know that's only 5 minutes, but for everyone, do you want to list the top 5 emerging markets just so that people know where they are?
Okay. So the big ones to think about are China, and I would categorize the rest of it as just East Asia, which is, say, Korea, Vietnam, Thailand, Taiwan, Indonesia. Then you would have India, and probably you'd say India, Bangladesh, Pakistan as a cohort, and then you would have Africa, and you probably have sort of Africa A, like in the cricket, you'd have Africa and Africa A. So you'd have the harder parts of Africa, let's just call it, and then maybe the more South Africa, Zimbabwe, sort of type Africa. You can also think about the Middle East, places like Turkey have generated some really good returns for people over the years. Bulgaria, Eastern Europe, Eastern Bloc, and then also you would also be looking at places like the Caribbean. So like Mexico is the one that stands out in my mind as a market you kind of want exposure to, but Colombia, northern parts of South America, and then obviously the big ones is Brazil. So the traditional is the BRIC. So Brazil, Russia, India, China. That's your traditional emerging markets.
Probably not a whole bunch of money in Russia these days.
Look, I think the Russian part of it's probably got a bit difficult. But look, we'll leave that conversation for another day. That's a good little wrap. Hope everyone's having a great Christmas, New Year, and we'll be back next week with another little short on future generation.